It is Sunday evening, January 18th, 2026, and while silver appears calm at 89.94, the U.S. administration's new 10% tariff on UK imports has fundamentally broken the global financial plumbing, creating a geographic arbitrage trap that locks millions of ounces of physical silver inside New York, mathematically assuring that the critically short London Bullion Market Association, LBMA, will face a structural liquidity crisis, forcing the price of physical metal to exceed the 112.42 break-even point. And when it fully shuts, we're going to find out exactly how much physical silver actually exists versus how much paper silver has been promised. I have a feeling the answer is going to surprise a lot of people. Stay sharp, watch the data, and trust the math. The math of this geographic arbitrage trap is ruthless because it removes the inherent flexibility the bullion banking system has relied upon for decades, a flexibility that masks insolvency beneath a veneer of deep liquidity. What the world sees is a price, $89.94. A consensus arrived at by the interplay of hundreds of thousands of paper contracts. What I see is the precise point where the structural integrity of that consensus fails. The 112.42 figure is not a wild prediction. It is the fiscal gravity point. It is the cost of replacement. And the cost of replacement is the ultimate price floor in a stressed physical market. To truly grasp the magnitude of this impending fracture, we must move beyond the ticker and into the physical reality of moving 1 million ounces of silver across the Atlantic in the current environment. A standard transatlantic shipment of registered silver from a COMEX vault in, say, Delaware, destined for a secured LBMA vault near Heathrow, involves a logistical gauntlet that costs far more than the simple freight fee. We are talking about highly specialized, high-security transport. This isn't just loading boxes onto a commercial flight. This is organized movement of fungible wealth. First, the metal must be pulled from the registered category, requiring internal authorizations and legal sign-offs. Then, armored carriers, often utilizing private security details armed with tactical weapons, move the palletized silver from the vault to a dedicated air cargo facility at a major hub like JFK or Newark. The insurance alone on a $90 million shipment is astronomical, calculated not just on the value, but on the political and maritime risk of the route. This entire process takes days, requires extensive manifesting, and is subject to stringent customs declarations both leaving the US and entering the UK. Under normal circumstances, the entire round-trip cost, including transport, security, customs filing, and insurance, might run between 50 cents and $1 per ounce. This friction is easily absorbed by a modest $1 arbitrage spread. But now, layer the tariff over that process. When that silver arrives in London, its initial cost basis is $90 per ounce. If the LBMA uses that metal to cover a short, the paper market is momentarily satisfied. However, the bank is now holding a liability. That $90 million worth of metal in London, if it ever needs to return to New York, which, in a functioning global system, it absolutely must, will face the US import tariff. Under the current 10% threat, that's $9 million in instant, non-recoverable tax on the principal. Under the 25% threat, that's $22.5 million. This shifts the internal risk calculation of the bullion banks from one of simple logistics to one of punitive, permanent capital destruction. No sane trader, no matter how desperate the London market is, will willingly ship $90 metal knowing that if they ever want to undo the transaction, it will cost them $112.50 to bring it home. The flow paralyzes because the risk of the return leg is now economically fatal. The door is not just locked, it is welded shut from the inside, trapping the U.S. physical supply where it sits. The sheer scale of this self-inflicted wound, the massive repositioning of physical inventory in the first quarter of 2025, is what makes this situation so unique. We are not talking about a slow, gradual accumulation of metal. We are talking about a concerted, panicked, institutional action that saw cargo planes full of silver crossing the Atlantic week after week. The impetus was the internal chatter surrounding the Section 232 review. The banks, with their massive intelligence networks, saw the writing on the wall. The administration was classifying silver as a critical strategic mineral, citing its indispensable role in next-generation defense systems, renewable energy infrastructure, and advanced microelectronics. Their assumption was the standard playbook of trade wars. The U.S. would impose import tariffs to protect domestic producers or secure domestic supply, making it expensive for foreign metal to compete or enter. The solution? Move the metal before the import restrictions hit. Imagine the internal memos being circulated in the executive suites of JP Morgan, HSBC, and the other primary LBMA members. The risk analysis focused entirely on keeping their core inventory safe from U.S. customs duties. They were ensuring they could meet U.S. delivery obligations without paying a tariff. They were playing defense against trade protectionism. They calculated the cost of storage in high-security New York vaults, the insurance, the annual maintenance fees, against the potential cost of a 25% import tariff. It was a clear-cut decision. pay the storage fees now or pay the tariff later. They chose storage. Dozens of millions of ounces, enough to cover significant portions of the LBMA's unallocated exposure, were quietly flown across the pond and tucked into the safety of COMEX-eligible status. They believed they had outmaneuvered the government. They patted themselves on the back for their foresight. What they failed to grasp was the administration's pivot from trade policy to geopolitical strategy. This tariff is not about protecting U.S. miners. It is about leveraging the entire Western financial system to force a political concession on Greenland. By imposing the tariff on exports to the UK and EU, the administration weaponized the bank's own inventory positioning. The metal they moved into the US to protect is now a hostage in a geopolitical chess match, and the bullion banks are the unwilling pawns. They moved their supply chain vulnerability from London to New York, assuming the US border would be a shield. Instead, it became a cage. Let us dissect the LBMA's vulnerability, the phantom limb that they can no longer reach across the ocean to scratch. The vast majority of silver held by the LBMA is in the form of unallocated accounts. This is the financial industry's greatest magic trick, selling claims on metal that they do not physically possess, effectively lending out the same ounce multiple times. This works only if confidence is maintained and if the physical metal can be sourced instantly when a large client demands delivery. Historically, the COMEX in New York, with its deep registered inventory, served as the primary flexible backstop. When London was short, New York loaned or sold. The metal was on a plane within days. That relationship, that symbiotic lifeline, is what keeps the unallocated system from collapsing. The tariff cuts that lifeline. If the LBMA is, as rumored, short 50 million ounces to satisfy current and near-term obligations stemming from industrial contracts and ETF redemptions that demand physical settlement, they are facing a nearly impossible scenario. They cannot turn to Zurich, because Zurich's vaults are heavily integrated with the Asian demand centers, and any significant draw would instantly starve Singapore and Hong Kong, causing price spikes there that would make the metal prohibitively expensive. They cannot risk moving metal from Asia, only to have it face a potential future import tariff in the US, should they ever need to repatriate it. They are cornered. The only vault large enough to cover their shortfall is New York. The consequence of this paralysis is a phenomenon I call the inventory death spiral. The moment the arbitrage mechanism breaks and the price spread between London and New York starts to widen, two things happen simultaneously that accelerate the panic. First, every existing physical holder in New York, realizing that their metal is now uniquely valuable because of its trapped status, ceases to sell. Why sell a $90 ounce today when you know that London is desperate and cannot replace the metal without paying a $22 tax? The supply curve becomes vertical. Nothing is available at any price under the $112.42 floor. Second, the LBMA, forced to source metal from within the UK or Europe, must bid the price dramatically higher. This creates a feedback loop. Higher prices in London signal deeper desperation, causing New York holders to raise their reservation price further, tightening the trap even more. The paper price starts chasing the physical impossibility. We need to talk about the Greenland variable because this is the root of the weaponization. This isn't about the administration suddenly caring about Danish sovereignty or Arctic ecosystems. This is about leverage. Greenland holds colossal deposits of rare earth elements, vital strategic minerals, and, critically, significant potential for military and signal intelligence positioning. The administration wants control, or at least decisive influence, over that landmass. Denmark, feeling pressure from the EU and internal political factions, is resisting. The US needs a lever that causes immediate, widespread, and diverse pain across the European economic structure, forcing Brussels and Copenhagen to the negotiating table with urgency. Why silver? Because silver, unlike niche rare earths, is embedded in everything. It's a core component of the German manufacturing base, the UK's aerospace sector, and the semiconductor supply chain that runs through Ireland and the Netherlands. By imposing tariffs on the entire economic output of these nations, with the implicit threat of trapping their essential industrial mineral supply, silver, the US is maximizing systemic pressure. Furthermore, the tariff is engineered to escalate to 25% if no deal is reached. That escalation clause is the hammer. It is designed to make the European position untenable. The European strategy is traditionally to stall and hope for political change. The US strategy here is to inflict quarterly, escalating economic bleeding that makes stalling politically suicidal for the Danish government. The political reality on the ground in Denmark and Greenland suggests they are unlikely to cave quickly. The purchase of Greenland is seen by many in Copenhagen as an insult to sovereignty, a relic of 19th century colonialism. The ruling coalition is fragile, and capitulating to US demands on such a high-profile, emotionally charged issue would likely trigger a vote of no confidence. They are prepared to endure the tariffs for a time, believing they can manage the economic fallout better than the political fallout of a concession. This political rigidity is the fuel for the silver squeeze. Every public statement from a Danish official hinting at a stalemate or demanding greater respect is not just diplomacy. It is a direct upward force on the price of physical silver because it increases the probability of the 25% tariff regime becoming reality. Now, let's return to the invisible machinery I'm watching this week. The EFP spread, the exchange for physical, is the true canary in the coal mine. It is the moment where the paper market, the derivative game played by the banks, collides violently with the physical need of industrial users. When a major industrial fabricator, think a multi-billion-dollar solar manufacturer, needs 5 million ounces of silver immediately, they might hold a corresponding futures contract. To convert that paper promise into metal, they execute an EFP trade. Normally, the cost of swapping the contract for the physical bar is negligible. It reflects minor storage and transportation fees. If the New York spot price is $90 and the futures contract is expiring at $90.50, the EFP spread might be 50 cents. But when the LBMA is starving and industrial users realize that the tariff has made the UKI-EU supply chain unreliable, they will flock to the COMEX, which still has registered metal, to secure their supply. They will pay $92, $93, even $95 for an ounce of physical silver right now to avoid relying on the broken London flow. If the futures price remains anchored at $90 because the banks are still successfully shorting the paper market, and the physical price explodes to $95, the EFP spread has widened to $5. This massive dislocation signifies a total collapse of confidence in the paper delivery mechanism. It means institutions are willing to pay thousands of dollars extra per contract just to ensure they receive a physical bar, not a cash settlement. When that spread hits 5%, it means the financial trust in the system is dead. We are talking about not just a crisis, but the systemic failure of the physical arbitrage model. The margin hikes are the exchange's desperate preemptive defense mechanism. The COMEX knows that if silver hits $100, the amount of money required to back the current short positions of the bullion banks becomes truly astronomical. The margin requirement is the cash collateral needed to keep a futures contract open. If a bank is short 50,000 contracts, 250 million ounces, and the price jumps $10, their losses are instantly $2.5 billion. The exchange doesn't want to be left holding the bag if one of its clearing members defaults. So the moment volatility accelerates, they raise the margin. If they hike it 20% or 30%, it forces leveraged players, the hedge funds and proprietary trading desks, who rely on borrowing most of the capital, to either immediately inject billions more in cash or liquidate their short positions. Liquidation of shorts means buying back the contracts, which drives the price up even faster, creating a melt-up scenario. The COMEX is trying to administer measured pain to prevent a catastrophic explosion. My personal trigger, a 20% single-day hike, is the exchange signaling that their internal risk models are flashing red and that the physical situation is far worse than they are publicly admitting. It is the sound of the exchange tightening the noose on its own members. The linguistic shell game I mentioned earlier is already beginning. Watch the reporting from any outlet remotely connected to the bullion banks. They will shift the discussion from inventory to liquidity. Inventory is a static measure, how many ounces are sitting in the vault. Liquidity is a dynamic measure, how easily can I buy or sell a large amount without moving the price. The banks want you focused on liquidity because even if they only have 10 million ounces of physical metal, they can still trade hundreds of millions of ounces of paper, making the market appear liquid. But when delivery is demanded, liquidity evaporates instantly if there is no underlying physical inventory. They will also start talking extensively about eligible silver, which is silver in the vault but not available for delivery, positioning it as a comfort blanket. They want you to believe that eligible metal is just a filing status away from being available. In reality, that eligible metal is often held by long-term investors or institutions who have already decided to take it off the table, reserving it precisely for moments of systemic stress. They are not selling, they are holding their hostage. Let us consider the implications of the 112.42 mathematical floor on the broader industrial market. At $90, the cost of silver in a high-tech circuit board or a solar panel is manageable. It is an input cost, but not a defining one. At 112, the cost structures of entire industries shift. Solar manufacturers, already operating on razor-thin margins and dependent on massive scale, face immediate pressure. This is where the panic buying turns into institutional frenzy. They don't just buy what they need for the next quarter, they buy enough for the next year, draining the registered inventory and accelerating the squeeze. Because for them, the cost of paying $120 for an ounce today is less than the cost of shutting down a $100 million production line tomorrow because they ran out of silver paste. This non-price sensitive industrial demand provides an ironclad floor for the physical price that speculative buying simply cannot replicate. The two-price world is not merely a theoretical construct. It is a historical inevitability when fiat promises breakdown. If the LBMA is forced into cash settlement, option 2 in their poison selection, it will trigger a profound loss of faith in every single paper claim on silver globally. Think about the massive exchange-traded funds, ETFs, that hold silver. While some claim to hold physical metal, their underlying mechanism often relies on the LBMA's system for pricing and delivery assurance. If the LBMA declares its contracts are only good for cash, every person holding an ETF share suddenly realizes their investment is not an asset backed by metal, but a glorified dollar-denominated promise. The resulting stampede out of paper vehicles and into actual vaulted, hold-in-your-hand physical metal will be seismic. The premium for real physical bars and coins will not be 10 or 20%. It could reach 50 or 100%, decoupling the physical price entirely from the paper price that the banks continue to quote on the screen. The banks are not just fighting the price, they are fighting confidence. They are fighting the physical law that says you cannot be in two places at once. Their entire system is a derivative of fractional reserve banking applied to commodities. It works only as long as people believe the underlying asset is available. By imposing this tariff, the administration has inadvertently forced a stress test on the entire system's solvency. The LBMA's inability to borrow metal from the COMEX exposes the core fragility. They simply do not have enough physical silver to cover their promises. I have spent the weekend reviewing the historical precedents for this type of policy-driven market fracture. There are none that perfectly match the instantaneous, opposite-direction weaponization of a tariff on a strategic mineral. We have seen export bans, like those imposed on certain rare earths, and we have seen import tariffs, like those on steel, but never have we seen a government intentionally lock down a vital strategic supply within its own borders as a lever against a third party. This is a novel, aggressive, and highly destabilizing use of economic policy, and its consequences for silver are unique. It means the usual banking countermeasures, shorting, leasing, moving inventory, are rendered inert by the legal framework. The 14-day countdown to February 1st is not a leisurely pace. It is the time limit for the exchanges to prepare for war. I anticipate extreme volatility this week, driven by the algorithms reacting to the geopolitical headlines and the institutional money trying to front-run the tariff. You will see massive, confusing swings. A rumor about a breakthrough in Greenland could send silver plunging $3 overnight. A statement about Danish intransigence could see it gap up $5. The key is to ignore the noise and watch the physical indicators. The EFP spread, the registered inventory reports, and the margin hikes. These are the signals that cannot be faked. The data points that reflect the true physical stress beneath the paper facade. My commitment to holding physical metal through this storm is unwavering because the risk-reward is so asymmetrical. If the tariff is waived, silver might dip back to $85, a manageable downside. If the tariff holds, the upside is $112.42 as a floor, with no discernible ceiling once industrial panic sets in and the LBMA starts facing delivery failures. We are positioned for a structural re-rating of silver, a move driven not by a speculative mania, but by an unavoidable logistic and political reality. This is not a trade. It is a recognition of physics and policy. If you are new to this market, understand the psychological warfare that is about to ensue. The media will minimize the crisis. They will interview economists who claim the tariff is temporary and irrelevant to the long-term fundamentals of silver. They will repeat the mantra that the market is deeply liquid. They must maintain this narrative because the moment the public believes the LBMA is short on metal, the entire fractional reserve commodity system risks a run. Your ability to resist this propaganda, to trust the math over the headlines, will define your success over the next 6 months. The banks are facing a crisis of their own making. They were too clever by half, assuming standard trade tactics. They moved their most critical asset into the precise geopolitical cage designed to trap it. Now, as the Sunday evening quiet settles, as the traders finish their dinners and prepare for the volatility of the Monday Open, the cold reality is setting in. They have 2 weeks to convince the U.S. administration to dismantle a tariff designed to achieve a massive strategic geopolitical goal, a tariff that is backed by the full weight of the presidency. The fate of the London bullion market now rests not on the supply-demand curve of silver, but on the political will of the Danish government and the geopolitical leverage of the U.S. And based on everything I know about high-stakes international negotiation, they are not going to blink quickly. They are willing to let the silver market burn to achieve control over the Arctic. The sound you hear is the faint click of the lock turning on the vault door. The metal is trapped. The price surge is mathematically mandated. We are witnessing the beginning of the end of the paper-silver dominance. The signal was sent this weekend. The question is whether you're going to listen. If you want to understand how the banks set this trap for themselves in the first quarter of 2025, how they moved all that metal ahead of the Section 232 review, there's a deep dive on that topic that I'll link in the description. But right now, you need to be focused on the next 14 days because the clock is ticking and the valve is closing. And when it fully shuts, we are going to find out exactly how much physical silver actually exists versus how much paper silver has been promised. I have a feeling the answer is going to surprise a lot of people. Stay sharp, watch the data, and trust the math. The math demands a forensic examination of the logistics, the hidden machinery that ensures the paper price you see on your terminal is tethered, however loosely, to the physical reality of a silver bar. When I talk about the 10% tariff, which translates to $9.0 per ounce at Friday's closing price, I'm not just talking about a number on a customs form. I'm talking about a $9,000 barrier that stacks on top of every existing friction point in the transatlantic silver supply chain, creating a mountainous hurdle that no rational arbitrage trader will dare attempt to climb. Consider what is involved in moving 1 million ounces of silver from a COMEX vault in Delaware or New York to an LBMA vault in London. This is not a FedEx package. This is a highly specialized, high-security operation. First, you have the physical labor and internal movement within the vault, the weighing, the auditing, the preparation of the manifest, a cost that typically runs cents per ounce, but which becomes complex when banks are trying to obscure the movement. Then comes the security, armored transport from the vault to the airport or the port. Specialist, high-security air freight is the standard, often handled by a small, select group of carriers who specialize in high-value cargo, demanding specific routes, armed guards, and classified security protocols. Insurance premiums for such cargo are astronomical, and they are calculated not just on the value of the metal, but on the perceived risk of the journey, including geopolitical friction. When the U.S. government announces tariffs tied to a massive diplomatic confrontation over Greenland, those insurance underwriters immediately price in higher political risk, causing the cost of insuring the transatlantic voyage to spike, adding another layer of unquantifiable friction onto the movement. This is the invisible machinery grinding to a halt. Under normal circumstances, the total friction, shipping, insurance, handling, internal fees, might be $0.50 to $1.0 per ounce. An arbitrage opportunity is usually viable if the London price exceeds the New York price by $1.50. That differential is enough to motivate the transfer. But now, layer the 10% tariff, $9.0, on top of that friction. The differential needed to justify the move instantly jumps to $10.0 per ounce. London must trade at $10 higher than New York simply to cover the new mandated friction. And even then, the trade is marginal. But here is the killer detail that the banks are agonizing over this Sunday night. The tariff is not applied on the export from the US to the UK. It is applied on the import into the US from the UK. The psychological deterrent is the round-trip cost. When a bullion bank ships 1 million ounces from New York to London to cover a short position, they are not just looking at the immediate cost of getting it to London. They are looking at the replacement cost. If they ever need to bring that metal back, or if they need to replace it with metal sourced in Europe, they are guaranteeing themselves a 10% loss on the value of the metal, escalating to 25%. This is the essence of the one-way valve. By sending the metal to London, the banks effectively burn the option to ever use it again in the US domestic market without catastrophic penalty. They are setting their own inventory on fire, guaranteeing that if they ever need to replace that 1 million ounces in New York, they will pay a minimum of $9 million in tariffs. No rational treasurer, no risk manager will sign off on a shipment under those conditions, unless the need in London is so existential that the guaranteed loss is preferable to an immediate default. That existential need, I suspect, is arriving faster than anyone in the paper market cares to admit. Let S peer further into the abyss of the LBMA, S true vulnerability, the nature of unallocated silver. This is where the paper game becomes almost criminal in its absurdity. The vast majority of silver held by individuals, institutions, and even many ETFs in London is not allocated. It is unallocated. What does that mean? It means you don't own a specific bar with a serial number in a specific vault. You own a liability on the balance sheet of a major bullion bank. The bank promises to deliver silver to you on demand, but they don't necessarily hold 100% of the physical metal required to cover all those claims. This fractional reserve system is the true invisible machinery of price suppression. It works perfectly as long as clients have confidence that the metal can be sourced quickly from the global network, New York, Zurich, Hong Kong. The banks rely on geographical liquidity to paper over their inherent physical deficit. The tariff announcement systematically cripples the single most important source of that external liquidity, the COMEX vaults. When the LBMA faces a delivery demand, usually they can execute an exchange for physical swap. moving paper contracts around while arranging for a shipment from New York. For that mechanism, the EFP is the grease in the system. But when the cost of moving the physical metal underpinning that EFP explodes by 10% or 25%, the EFP spread has to widen dramatically to compensate, or the counterparty in New York simply refuses to deliver the physical metal. This is why I am tracking the EFP spread like a predator. When it blows out, it is the market's scream that the physical metal is no longer available at the paper price. Imagine the internal meetings happening right now, this Sunday evening, in the gleaming glass towers of the major bullion banks in London. They are running simulations on their exposure. They are calculating the cost of cash settlement versus the cost of meeting delivery obligations under the 10% tariff regime. Cash settlement, option 2. In my earlier analysis, is the nuclear option for confidence. If the LBMA announces that due to extraordinary geopolitical circumstances, the euphemism they would surely use, they are forced to settle physical contracts in fiat currency, the market's trust in the LBMA, the very foundation of the global price discovery mechanism, collapses instantly. Every pension fund, every sovereign wealth fund, every institutional investor holding unallocated metal will simultaneously realize their asset is actually a counterparty liability, and the rush to convert any remaining paper claims into physical metal that is outside the banking system will create a cascade of panic buying across every other exchange from Shanghai to Singapore. The risk is systemic. Now, let's pivot to the COMEX vaults and the psychological terror of the registered to eligible shuffle. For the non-analyst, this sounds like accounting jargon, but it is life and death for the paper market. Registered silver is the metal that the vault owners have certified is ready and available for immediate delivery against a futures contract. It is the supply buffer, the assurance that the paper market is honest. Eligible silver is metal that is sitting in the vault, meets the quality standards, but is not available for delivery against contracts. It is often earmarked for internal bank accounts or industrial clients. The movement from registered to eligible is not a trivial decision. It is the action of a bank or major holder saying, "I'm pulling this metal off the market. I will take a short-term hit on liquidity, but I refuse to risk this metal being delivered out of the COMEX system." Why? Because every ounce that moves from registered to eligible is an ounce the bullion bank doesn't have to worry about replacing at a 25% penalty. If they let an ounce leave COMEX today, they know that ounce might be needed in London to cover a short, and if it is, the round trip is now catastrophically expensive. And so they lock the doors. They perform a quiet, bureaucratic exercise, a few keystrokes in the vault management system that transforms millions of ounces of market inventory into sequestered holdings. When we see a dramatic drop in registered inventory this week, it won't be because the metal physically left the vault. It will be because the banks are placing their remaining inventory under strategic lockdown, hoarding their remaining stock like squirrels preparing for a nuclear winter. This behavior, invisible to the general public, signals that the COMEX vault is transforming from a global supplier into a strategic reservoir of last resort. Let us take that 22.50 friction point, the 25% nuclear option based on current prices, and look at it through the eyes of an industrial buyer. Consider a major European solar cell manufacturer who needs 5 million ounces of silver paste annually. Their contracts are denominated in euros, their input costs are denominated in dollars, and their margins are already razor thin due to aggressive Chinese competition. This manufacturer typically sources raw silver from London or Zurich, relying on the smooth flow from COMEX through the arbitrage mechanisms. Suddenly, the cost of their primary input is facing a potential, non-negotiable 25% tax. They cannot absorb this cost. Their options are terrifying. Halt production, pass the entire cost increase onto customers, making their product uncompetitive, or panic buy forward supply now before the 10% tariff kicks in. The fear of the 25% tariff on June 1st creates an immediate violent demand pull in January and February. Industrial users who need metal in Q2 or Q3 cannot wait. They must lock in supply at a 10% premium today to avoid a potential 25% premium in 3 months. This forces non-price sensitive industrial demand directly into the market, competing with the already distressed LBMA banks who also need the physical metal. This is the mechanism that will push the physical price past the 100 mark purely on industrial necessity and structural arbitrage breakdown, divorced entirely from retail investment sentiment. The price discovery is shifting from the speculative futures market to the desperate corporate procurement offices. To understand the true nature of this trap, we must return to the political theater of Greenland. The media is framing this as a routine trade dispute, a high-stakes negotiation where both sides expect to meet halfway. This is fundamentally naive. The administration did not select the UK and EU nations for random tariff imposition. They selected them because they are the key players in the Greenland negotiation. The tariff is not the goal, it is the bludgeon. And the administration knows that for the Danes and the Greenlanders, this is not a commercial transaction. It is a matter of national dignity and self-determination. Greenland, largely autonomous but still constitutionally part of the Kingdom of Denmark, holds the key to the Arctic's strategic mineral wealth and military positioning. For centuries, the narrative has been about resisting external influence. If Denmark agrees to a deal that transfers effective control of Greenland ES strategic assets to the US, the current Danish government will face a massive political crisis, almost certainly collapsing. The opposition parties are already unified against any perceived sale. Furthermore, the Greenland government itself, which has increasing control over its own resources, has a vested interest in maximizing the political leverage of their minerals and land, which often means resisting quick deals with superpowers. They are playing for the long game, betting that the US administration will soften its stance or that the political landscape will change. This internal political friction in Copenhagen and Nuuk is far stronger than the economic pain caused by the tariff. The pain is diffuse across the European economy. The political cost of surrender is concentrated on the Prime Minister's desk. Therefore, the probability of a swift, comprehensive deal that removes the tariff by February 1st, or even by June 1st, is structurally low. The administration has created a brilliant economic trap for the silver market, betting that the banking pain would force the political concession. But they may have overestimated the political flexibility of the Danes on a sovereignty issue. Every analyst needs to internalize this. The silver price is now directly linked to the immovable object of Scandinavian national pride. Let's re-examine the Q1 2025 front-running mistake, because it reveals the depth of the bank's miscalculation and the administration's strategic patience. When the Section 232 review was announced, the bullion banks immediately understood the threat. The US government might declare silver a strategic material and restrict imports from Europe to secure domestic supply. Their logical standard playbook response was to move physical metal into the US. They wanted their inventory protected inside the fortress walls before the gates closed. We saw massive record-breaking movements of 1,000-ounce bars across the Atlantic. They thought they were genius, ensuring their inventory was safe from American protectionism. What they failed to anticipate, or perhaps dismissed as too high risk, was the administration's use of the tariff as a targeted geopolitical weapon aimed at exports out of the UK-EU, encompassing the metal they had just moved. The official announcement explicitly targets imports from the UK and EU nations into the US, yes, but the key is the retaliatory nature of the tariff. The tariff itself is the penalty for not reaching the Greenland deal. The tariffs apply broadly to all imports from those nations. The consequence is that any metal shipped out of the COMEX system to London must be replaced eventually, and that replacement metal, sourced from the tariffed nations, or even simply brought back home, now carries the penalty. The banks moved their metal into the U.S. to protect it from import restrictions, and the administration responded by making the U.S. a roach motel for physical silver. You can check in, but you can't check out without paying a catastrophic fee to replace your inventory. The banks engineered their own imprisonment. The downstream impact of this panic is already manifesting in the smaller, less visible corners of the commodities world. I'm tracking the premiums on small industrial grain. I'm not talking about the massive 1,000-ounce bars. I'm talking about 10-ounce coins, 1-ounce rounds, and refined silver products needed by smaller manufacturers and mints. These smaller formats are already trading at premiums that reflect $95 to $100 silver, even while the paper market lingers below $90. The spreads that I mentioned earlier, the gap between the bid and ask, are widening not just for futures, but for these physical products. The retail dealers, the refiners, the small industrial users, they are the canaries in the coal mine. They have no paper mechanisms to hedge their exposure. They need physical metal, and they are locking in supply at elevated premiums today. Because their internal risk models are screaming that a 25% tariff in June means physical silver will be unavailable regardless of price. This real-world localized price discovery is the true signal that the paper market is ignoring. This brings me back to the urgency of the next 14 days and the monitoring of my key triggers. When futures markets open tonight, Sunday evening Eastern Time, the immediate reaction of the algorithms will be crucial, but ultimately misleading. The initial move might be a muted dip, a technical sell-off based on algorithms that read tariffs, or a strong dollar, requires metals weaker. This is the head fake. The real tell will be the institutional response in the subsequent hours and days. If silver gaps over $92, it means the big players are already pricing in the 10% friction and are positioning for the supply paralysis. If it dips to $85 on skeptical headlines, that is the market's last gasp of disbelief. And my personal position is to treat that dip as the final opportunity to increase core physical holdings. The margin hikes, which I predict by Tuesday or Wednesday, will be the exchange's attempt to restore order by creating paper market friction. They will raise the required collateral for every futures contract, forcing out undercapitalized short sellers and leveraged speculators. This move is designed to suppress volatility and, by extension, price. But here's the irony. A margin hike, particularly one exceeding 20%, is a tacit admission by the exchange that they are terrified of the underlying physical exposure. They are trying to reduce the amount of paper claims in the system because they fear the paper claims might try to convert to physical metal that is now trapped behind a tariff wall. The more aggressive the margin hike, the more confidence I have in the underlying physical thesis. Finally, let us consider the concept of force majeure once more. This is the legal escape hatch, the declaration that a contract cannot be fulfilled due to unforeseen circumstances beyond control. If the London-New York spread hits 5% or more, meaning London is trading at $95 and New York is at $90, for example, the LBMA will be on the precipice. Why? Because that 5% premium is still not enough to overcome the 10% tariff cost. The arbitrage mechanism is failing. If the premium hits 10%, it means the market is desperate enough to cover the basic tariff cost, accepting zero profit on the move. When the spread hits 10%, it signifies that the price in London is being driven by existential necessity, not by profit. This is the point where the lawyers start drafting the force majeure declarations. They will cite the unprecedented trade sanctions, the geopolitical crisis over Greenland, and the resulting non-economic costs of moving strategic metal across the Atlantic. They will declare that the fulfillment of physical delivery contracts is impractical or impossible. If the LBMA resorts to cash settlement or force majeure, the consequences will ripple across every single market tied to paper derivatives. It is not just about silver, it is about the integrity of the entire global commodities clearing system. If the world's largest bullion market can simply declare that their physical contracts are nullified due to government policy, what does that say about the security of owning paper oil contracts, or paper copper, or paper platinum? It proves that these paper markets are not robust, reliable mechanisms for price discovery or delivery, but fragile structures resting on the assumption of free movement and unrestricted arbitrage. The crisis in silver will become a crisis of counterparty trust across all commodities, driving massive capital flight into truly decentralized, censorship-resistant, and verifiable physical assets. This is the ultimate domino the banks are trying to prevent from falling, and the tariff bomb has placed it squarely on the edge of the table. We are watching the slow-motion detonation of a geopolitical trade weapon that was never intended to adjust the price of silver, but rather to extract a concession on Greenland. The collateral damage, however, is the structural integrity of the $100 trillion global derivatives market. The banks are trapped. The metal is trapped. The clock is counting down to February 1st, and the price of silver is simply the gauge of the pressure building inside the closed system. I remain focused on the physical inventory numbers, the EFP spread, and the political rhetoric out of Copenhagen. The silence tonight is the deafening calm before the market realizes that the physics of tariffs have trumped the flexibility of fractional reserve banking. Trust the math. It doesn't lie.